Hi folks, and welcome to this video on amortizing premium on bonds. Now, this is a premium bond, and I'm not sure if you have your data in front of you, but I'll quickly review it. We have a $400,000 bond. That's our principal or face value. Our coupon rate is 8%. Our market rate is 7%. Our bond term is 3 years. The bond pays interest semi-annually beginning on September the 1st. The issue date of the bond is March the 1st, 2011. So let's begin this by calculating the present value or the amount of cash that the investors would give us at the issue date, which is March the 1st. So now what I've done here, using the calculator, I've set my P/Y to 2 because there's 2 payment periods a year. I've put in there $400,000 as my future value. I had to calculate my payment, and I did so by using my coupon rate and multiplying that coupon rate by a half because my bond pays interest semi-annually, and multiplying all that by the principal or face value to get $16,000 as my semi-annual payment. I know I'm making that payment 6 times over the 3-year period because the bond pays semi-annually, and I know that my annual market rate is 7%. So when I compute PV, I would get $410,657. And you can see here that because our market rate is less than our coupon, our bond is paying more than the market is paying. So it stands to reason that investors would pay a premium amount or more than the principal or face value. Henceforth, you should expect to get, in terms of proceeds, an amount that's greater than $400,000. Now, if we asked you to calculate the value of the interest expense over the entire term of the bond, let's see how we could do this. The one way that will always work for students is to use the first method, which compares the actual amount that you're paying back to the investors to the actual amount that you borrowed. And we know that we will be paying back principal, which is $400,000, plus interest, which is $16,000 every 6 months for $16,000 every 6 months over the 3-year period, which means we're going to be making 6 interest payments over the 3-year period. So therefore, the total amount that we would pay our investors back is $496,000, but they gave us $410,657. So our interest expense should be $85,343 over the entire period. Another way you can do it is we know that our interest expense over the term of the bond, because we have a premium bond, will be less than the amount of the interest that we're paying. So therefore, the interest expense would be equal to the interest that we pay less the amount of amortized premium over the term of the bond. And over the term of the bond, we already know that we would be amortizing $10,657, the difference between the principal value and the carrying value of the bond at the issue date. Okay? So now, we can calculate that interest expense as the difference between the interest paid and the amortized premium. And over the 3 years, we will be amortizing the full premium and paying out a total of $96,000 in interest. So therefore, our interest expense would be the difference, which is $85,343. Now, this calculation doesn't always make sense to students at first, but maybe once you see your bond table, it might make a little more sense. So let's begin. Now, we can see here in the first period of the bond, or sorry, not the first period, but the date we issue it, we already recognized in the table an unamortized premium of $10,657 and a carrying value of $410,657. So now what would the journal entry look like if we were to record the bond issue? Well, when we issued the bond on March the 1st, we recognized that we received cash from investors of $410,657. We're going to create a bond premium account of $10,657, and because when we create it or set it up, its normal balance is a credit, we're going to credit that account. And we're also going to credit the bonds payable of $400,000. And that sets up the journal entry to issue the bond. And again, we can get this from our bond table. Now, on September the 1st, that's the end of our first interest payment period, or interest period. So now we're going to pay at September the 1st, $16,000 in interest. We're going to book interest expense of $14,373. How do we get that? Well, we take the book value of the bond to open the period, which in our case is $410,657. All right, that's the book value of the bond or the carrying value at the beginning of this period that ends September 1st. So that period actually begins March 1st and ends this date. So we take the carrying value to open the 6-month period ending this date and multiply it by our semi-annual market rate. We always calculate interest expense using the market rate. Okay, and in this case that market rate is semi-annual. So because we're paying interest semi-annually. So we'll get $14,373. The difference between the interest that you're paying and the interest expense during that period is going to give you the amount of the premium that you've amortized. So now we can see a relationship here that we can use to actually calculate the interest expense over the entire 3-year period. We know that our interest expense is going to equal interest paid less any amortized premium. And over the entire 3-year period, we will have paid out an entire $16,000 times 6 for 6 periods, which is $96,000. And we would have booked, in addition to what we booked as amortized premium in the first period, all these amounts here for amortized premium. And we would have amortized a total of $10,657 in premium. So therefore, we know that our interest expense would be equal to the difference between the interest paid, which is this amount, right, less any amortized premium. Well, by the time you get to the end of the 3 years, you would have amortized it all. So, amortized it all, which would be here, $10,657. So therefore, you're going to get $85,343 as your total interest expense over the 3-year period. So you can sometimes use these relationships that you see in the bond table, however you learn them or set up your table, and say, hey, I already know my interest expense is going to be the difference between interest paid and premium amortized in every period. So that should be happening. That relationship holds true every period. So therefore, for the total over the 3-year period, the same thing holds. So you can have, in effect, use this method for the premium bond to calculate your interest expense before you even do the table, if you understand some of these critical relationships. Okay, so now let's use our bond table to prepare the journal entry on September the 1st, 2011. So now we can use our table. Now it might be helpful if we could pull up the table for you. Maybe we'll just keep our table here. And you can see now, if you're looking to your table to figure out what the relationships are and what the entries would be on September the 1st, you can see here that over the 6-month period ended September the 1st, I'm going to debit my interest expense for $14,373, which is exactly the amount of interest expense I calculated when I did my bond table, right? Therefore, I know that I'm going to book interest expense of $14,373 over the entire 6-month period, but I'm also amortizing premium of $1,627, which is here. Okay, now don't forget, because we had set the premium up in a credit, when we amortize premium, we're debiting it. So we have to reduce it or debit it by $1,627, and then we're going to credit cash for $16,000. Okay, now after you've done the March 1st, 2012 entry, I'm not going to bother to do it right now. I think you probably, after what we've done in class, get the hang of a bond. But let's now do something else with this. Let's say we decided to retire the bonds for $409,000 on March the 1st. Now this assumes we've already made our interest payment. So we're down here and we have a carrying value of the bond on March the 1st of $407,346. Well, to make the entry to retire the bond, we're going to pay out our investors $409,000. We also have to get rid of the bond and its associated unamortized premium. Why the unamortized premium? Well, because now that we're retiring the bond, we're not going to be amortizing it anymore, right? We're not amortizing any of the premium. So we need to remove it from our books. Well, don't forget, when we set the premium up, we credited the whole amount, right? So to get rid of the unamortized premium, we're going to have to debit it by $7,346. So we did that when we removed the bond at its face or principal value, because don't forget, on March the 1st, you recorded it at its principal or face value. So you have to get rid of it at that value, get rid of any premium that you're not going to amortize, credit your cash, and the last thing you do is you figure out, gee, am I a little light on the debit or the credit side? Well, in this case, you're a little light on the debit side. And whenever you're light on the debit side, that's going to be a loss. And that loss on bond retirement will show up in your other revenue and expense section of your income statement. Okay? So now, what would happen if now, instead of assuming that we didn't, actually, what I guess I should say is, we didn't really say in this question when the year end was. We're just setting up a bond table, making journal entries to pay interest and record interest expense, right? But what if I said to you, I'm changing the deal on you. Now I want you to assume that there's an April 30th year end every year. So that means we're going to have to make an entry to accrue interest, which means set up an interest liability at the end of April 2011, 2012, and 2013. We won't have to worry about April 2014 because don't forget, the bond matures before that, March the 1st, 2014. So what I'm going to do here is I'm going to walk you through the calculations at each of the year ends, April 30th, 2011, April 30th, 2012, and April 30th, 2013, and show you what the balance sheet would be like. So let's start. First thing I always say is if you've got to make an adjusting entry, in our case it's April 30th, 2011, on what line of the table does that date fall? Where is April 30th, 2011 falling? In what 6-month period? It's this one. How do I know that? Because that's the issue date, March the 1st. That's also the beginning of the first 6-month period. So April the 1st is going to fall somewhere in here, right? Somewhere where my arrow is. Right in there. That's where it falls. So therefore, it falls in the 6-month period that ends September 1st. So what I want to do now is I want to go to this line in the table and prorate or allocate interest expense. This is interest expense for a full 6-month period that ends September 1st. But I only want interest expense for 2 months. The whole month of March and the whole month of April, because I only want to set up interest to be paid. I only want to set up interest expense and interest to be paid based on that 2 months of the 6-month period. So what I'm going to do is I'm going to go here and I'm going to say, well, I'm going to take 2/6 or 2 over 6 of $14,373 because this is interest expense for 6 months. I only want it for 2 months. My 2 months are March and April, right? So that interest expense is going to be $47.91 when I do this calculation. All right? I only want to amortize not the whole $1,627. That's for 6 months. I only want it for 2 months. So I'm going to allocate that over 2 months to get $542. And I'm going to debit the premium because I'm amortizing it. And now I'm not paying any interest out yet, but I'm just accruing it or setting it up to be paid when we make the next interest payment, which would be September 1st, 2011. So therefore, I'm going to take my $16,000 and set up a liability by multiplying that $16,000 by 2 over 6. Again, $16,000 is the interest I would pay out for 6 months, but I only want to set it up as a liability for 2 months. Okay, so that I can make my accounts on my balance sheet right for the year end. So therefore, I'm going to have $53.33. So if I did a balance sheet now on April 30th, 2011, you can see my interest payable is a current liability. Why is it current? Well, because I'm going to be making that payment and then some for the other 4 months on September the 1st, 2011. So it'll be made within the current operating cycle, so therefore it's a current liability. But now in the non-current liability section, I have my bond described as an 8% bond due March 1st, 2000.